Good morning. Fantastic to have you back. Thank you for joining us. Let's understand what's happening in the world. One side you've got shortage, one side you've got acute power cut by the Chinese, and then on the other side you've got the dollar index which is spiking up. Too many macro variables are moving too quickly. How would you assess them?
Hi, hi, Nikunj. Good morning. Can you hear me?
Yes, please go ahead.
Okay, so I think you're right. I mean, a lot of moving parts right now globally. I think things are becoming slightly more negative. Whereas what we think, as far as India is concerned, the narratives, the commentary coming out from the companies, that's becoming even stronger. What we are seeing right now, as far as most of the companies, when we are talking to post the second wave, as we saw most of the states and cities opening up, the demand has actually come back very strongly, and this momentum actually is feeding quite positively as far as the overall outlook is concerned for most of the corporates out here. But very important, I think, Nikunj, what you mentioned about some of the global macros, I think those are going to create some amount of temporary disruptions as far as the risk taking ability is concerned. So there could be periods where, let's say, some of the emerging markets may see volatility going forward, which is definitely bound to hurt India as well in some form or fashion. But I think relatively, in terms of visibility of growth today, in terms of stability of the reform, stability of the overall government's resolve to bring back the growth, I think on all those front, India stands pretty strong. So some of these volatility, and given where we are in terms of the valuations, where there is very little room for error, there could be some bit of volatility. But I think on the whole, it should be fine. We believe that long-term outlook for India is turning positive. So hence, investment as far as equities are concerned, should be looked at with a long-term view. The near-term expectations need to be tempered down because of the risk which you mentioned. So I think these are very, I would say, relevant times for the investors to realign the portfolios as well. We've seen a lot of speculative trades also taking place. So I think on the whole, the long-term picture for India looks pretty okay. Just it's the short-term where the expectations need to be tempered a bit.
How would you adjust your portfolio, assuming that what China is trying to do will have far-reaching implications? Because if the factory of the world is looking at slowing down, it will have an impact on demand as well as supply. And rarely do you see that demand and supply, they both change in such a dramatic manner.
I mean, you're right, Nikunj. The second largest economy of the world, if that is going through a bit of that slowdown, it is going to have its own ramifications. So you're right; they have a big impact globally. But at the same time, let us not paint this whole scenario with one brush, because there are parts to the story which benefits India. We have seen across various categories and segments, most Indian companies are getting more inquiries because as people shift from China, there is an opportunity for the Indian companies which has also come about. So I think that is the positive aspect of what's happening. The other bigger macro change is the policies there are creating some amount of fear in the minds of investor, which is also in a way, going to lead to some amount of risk off from those economies, and can lead to some, bit of more allocation to economies where there is stability over the longer term. So I think these should be also sort of, taken into consideration when we are thinking about what's happening in China. On the other hand, there could be temporary imbalances which could get created, the likes of what we are seeing now, soaring energy prices, some of the key raw materials prices may go up, and that's going to cause the problem for some of the companies in India which use them as their key inputs. Those prices going up, freight costs going up, I think this is one of the key concern most of the corporates are very clearly sounding off. And I believe that companies where they have ability to pass on the cost increases will fare bit better. But the companies where the ability to pass on these price increase will have to take them in terms of their margin impact. And Nikunj, I was hearing what you mentioned about the very heightened expectations on earnings and very marginal room for error. I think wherever the companies disappoint over the next 2 quarters because of the margin pressure, we could have some amount of nervousness on those stocks is what I believe. But on the whole, these are temporary imbalances which we believe should normalize as some of the supply chain normalizes going forward.
Vinith, one sector where you've really created a lot of wealth for your investors is the entire chemical sector. It was a play on India's manufacturing ability. How do you see dynamics of the chemical sector changing and some manufacturing sector changing? Are we at like a renaissance of manufacturing given what is happening in the world? I'm again and again going back to China because I'm trying to wrap my head around that what would be the implications of this change for Indian companies, whether it is in the chemical space or manufacturing or engineering space?
See, as I said, the two ways to look at it as far as let's say, and I'll take the chemical industries as an example because that's something which is in a way directly affected with what's happening in China, and that is, growing industry. The relevance of that industry is actually becoming, more in the global context versus where China is. So China is large, China is giant, and there is no chance where we can say that we'll be able to compete with China in terms of where we are today. Companies have emerged bigger, companies have emerged stronger, and companies in some specialty segments have become very quite dominant, is what I can say. Good part is that we are still small in the global context, and hence I think some of these companies are sensing uh, continuing opportunity when it comes to business, and which is what is leading them to spend more on capacity expansion. So if we take a block of 3 years, for the last 7 8 years, I've been tracking these companies. Every previous block of 3 years is the spends by these companies have only gone up, which is a clear indication of their confidence on the business momentum. So this is, the bottom-up view, what we try to, gather from what the companies are doing. So that's one aspect. The other aspect is, there are uh, many key starting materials, key raw materials, which these companies are still sourcing from China as a base. And I think that is where the challenge is going to be in terms of the profitability for the, let's say, next 1 or 2 quarters till the time these raw material issues or the price normalizes. So I would say that business momentum is strong. Profitability may have some variability over the next few quarters, but on the whole, I think the confidence visibility is high. Now, the third aspect is evaluations, which is where I think one needs to sort of take a call. At some valuations, the margin of safety becomes lower. We have rebalanced our portfolios. We have, taken book profit in some of these names. We have reduced our weightage, but we've not exited the segment because we still believe in continuity of the business prospects. Valuations are high, but as the visibility keeps improving, I think over a period it keeps creating value for the investors.
Good morning, Vinit. I was just going through your portfolio and then seeing the last couple of weeks' performance as well for our stock markets. And there's been one sector, I'm moving away from China and the macros, which has really outperformed is the real estate sector, which, seems to be missing as of now, unless, you were talking about the rebalancing, it's being taken care of. Are you going to be adding real estate? Because that's a multi-year cycle when it goes up.
Yes, the way we have sort of thought of playing the real estate is through the proxies. Once the demand for real estate goes up, we will see it is backed up by demand for various, categories which are linked to the real estate. So be it the home building, be it the tiles, be it the sanitary ware. So I think what we've electrical cables, what we've sort of done is to play the real estate. We've tried to look at the proxies of real estate, where we believe as the demand for real estate improves, it will create its own effect on some of these categories as well. And the other good part about being invested in the building materials as a category is the fact that it just not caters to the new demand of real estate, but what is also happening, we are seeing there is a lot of renovation which is taking place on the existing home as well. There is a lot of upgradation which is taking place, and some of these companies, it seems, are getting benefit out of that as well. So I think real estate, you're right. I think after 7 or 8 long years, we are seeing the outlook improving. That's a good trend. We want to capture it through some of the real estate proxies and not directly, let's say, buying real estate companies. And I think that's how we have placed our bets in the portfolio.
The other sector that I see, missing in the portfolio, two of them actually. One is metals, and the other one, if I could talk about, is pharmaceuticals, barring Ipca Labs. What's the rationale behind that? Do you think that pharmaceuticals have peaked out?
No, I would say that pharma generally, we've had a good long-term positive view. It is just that at certain point in time where we have seen the valuations rise, we have sort of taken decision to trim the exposure at some point. But our long-term view on the healthcare sector continue to remain positive. In fact, our the dedicated healthcare fund, this is one of the funds which we are also pushing at the moment, because we believe that the healthcare spends globally and in India is going to increase, the penetration is going to increase. For Indian companies, again, just like specialty chemicals, we have pharmaceutical, where I think India clearly has an edge, and they will be catering to the world demand. So I think that's something which is positive. And as economy opens up, I believe the sector is also likely to see positive growth. Some of the segments were, because of the lockdowns, even the healthcare market was impacted to some extent. I think those will sort of come back. So we have a positive view. At time and again, we keep in our diversified fund, we keep looking at companies at a particular price point. So we don't have a negative view. As far as the metals are concerned, I think it is again something which is we've been very selective. Some funds we have exposure, not a large part of our funds own metals, because of we all understand it is very cyclical in nature. The variables which affect the sector are too many, and it becomes very difficult to predict some of these variables. So we've kept it quite controlled in terms of the exposure. And at the moment, I would say that we are definitely somewhere closer to the peak. Considering the fact that we were talking of China slowing and China regulatory changes. I mean, these are very uncertain times, and China is a big economy which impacts the commodity price point. Plus, let's say if the US dollar continue to rise, that would be negative commodity. So I think it's better to be measured as far as the metal sector is concerned, and hence that's what is sort of showing in terms of our portfolio exposure as well.
Right. So Vinit, given that there are a lot of unknowns up ahead for us in terms of markets, and I mean, while I can see that your funds, that's the DSP small cap and mid cap funds, have way outperformed what the indexes have done, but the fact of the matter is also, besides the unknowns up ahead, it's also been a one-way move up practically for markets from the 2020 lows. Would you now recommend reallocating funds out of the small and mid cap schemes perhaps, and a larger allocation to large caps?
Okay, so I think we have so it's a very important point out here, and I think most investors probably are sort of grappling with this type of query in their minds, which we also keep getting from our investors. And I would say that to some extent, there's a merit in, let's say, reallocating some bit of your exposure from the small caps, particularly to the mid caps and large caps. As we have seen, there is a significant amount of rally which has happened in small caps. There is, bit of that speculative element also, which has led to some froth also getting accumulated, and what we are sensing is that there is a lot of noise which is creating exuberance, if I can use that word, in that category. So I think it makes sense to look at the mid cap is a good segment as such. I would say companies are doing well. There is a good amount of opportunity available for these companies over the next few years as the economy expands. So I think there's a merit in shifting, and that's as far as the broader thought on the categories are concerned. It's also good to look at let's say diversified flexi cap type of categories where you have a judicious mix of all the categories. So I think I would say that that's what investors can look at. And I think anyways, who are worried about the expensive nature of the small cap, I think for and would like to continue there. The only thing what I want to sort of again share as my thought is we may see volatility over the next in the short term, let's say, but as we are into an expanding economy, we are going to see the fruits of these growth percolating down to various segments. Over the next 4-5 years, I think it would still make sense to be part of the broader set of the corporates, and within which you will have each of these plays doing well. So you will have bouts of period where small caps may underperform, large cap, mid cap may outperform. But on the whole, I think over a period, if you have a right balance of mid cap, small caps, and have a good holding period, I think it should be fine even if you hold some bit of that small cap in the portfolio.
Thanks, Vinit, for that answer in particular. I'm sure all our retail mutual fund investors would really benefit from that advice. Good to speak with you as always.
Thank you.